Some people, many people, call accrued expenses accruals. Accruals. I recommend you don't do that because the word accruals can be ambiguous. Here, we're talking about liabilities for services or for goods we've already enjoyed, and the liabilities we're putting on our balance sheet, for example here, and their expenses that we're already recognizing in the income statement, reducing our net assets. To not be ambiguous, if you describe that as an accrued expense or accruing for an expense, then there's not going to be the risk of jumbling up the too short phrase accrual with other sorts of accrual, and there are other concepts that carry the same or very similar wording. So it might sound a bit picky or a bit too careful, but quite often spelling things out with more words reduces ambiguity and saves time, because the number of ambiguous remarks and confusion and, dare I say, arguments is going to be reduced. So there's going to be fewer errors. Okay, recognizing accrued expense. Now let's say we pay a previously accrued expense. This is rather like paying a supplier who sent us a bill. There may well be a bill intermediating, but in accounting terms, let's just say we're settling this in accounting terms straight from the accruals account. We might go through a payables account, but just to keep it simple here, we're paying some of this. Let's pay half. So we're going to pay half of 4, we're going to pay 2. Let's put 2 as a payment in our cash flow statement. Nothing else happens in this accounting period. Paid 2, started with 7 in the bank account. We're now at 5, so to make our balance sheet align with the cash flow statement, we need to reduce cash by 2. We put it in a cash book and then make the cash account in the nominal ledger. In other words, the accounts line up with the cash book and line up with the cash flow statement. Is this an expense being incurred or recognized? No, it was already incurred or recognized last time down here. So there's no more entries needed in the income statement. So let's have a look down below. Our profit or loss was none. We've got a cash inflow or outflow not showing up correctly yet. What's happened? We haven't booked this change here, which is we don't need that accrued expense anymore. So the thing we'd accrued for or recognized, we've now settled. So we only need half of the accruals now. We don't need the previous amount of accruals that we had. So accruals went down. When accruals go down, then assuming there's no profit or loss, then cash is going to be 2 lower than we'd expect given the profit or loss for the period. So no profit or loss, cash went down. Why did cash go down? Because we deployed 2 of our cash to settle this liability that we'd previously recognized. So paying accrued expenses costs cash, but it's not in the income statement this period because it was in the income statement last period, that repair. We recognize that repair back here in period 2. We're paying for it in period 3. And the last bit, let's say this cost us less than we expected, so we release accrued expense. No longer required. We put aside 4 in accounting terms, and let's say we get rid of half of this. So we only need an accrual for 1 at this point. This is an accounting entry. It's not a receipt or a payment. So there's nothing in the cash flow statement. Our expenses, with the benefit of hindsight, were overstated here. So we're going to have a negative expense, just like we had, if you remember, when the supplier gave us a credit note. It's the same concept, different figures. So we've got a negative expense. Our total expenses across this period would be 3, 4 having been recognized in period 2, and then in period 4, 1 of that being reversed. So net expenses for the whole of the periods 2 to 4 inclusive, the whole of this period. These net expenses are 3, 4 here, and 1 reversed out here. Reversing out an expense is not a cash item. So even though we've got a gain or a profit in the period in accounting terms, there's no change in the cash. And the reason is we have made an accounting entry to recognize the assessment, evaluation, reality that we had set aside too much in accounting terms for these costs to be paid. We had 2, we only need 1. Recognizing that is recognizing that expenses need to be reduced. That isn't cash, so this is a non-cash accounting item that is causing a profit, but it's not affecting cash. And the explanation is that the accrued expenses went down, and that causes cash to be smaller than that profit number would suggest.